So that prime lending rate, again, to remind you, now at the highest rate it has been in 13 years. Let's try and find out how we got here and bring in PwC senior economist. It's Christie Viljoen joining us this morning. Christie, hello to you. Let's talk about what happened yesterday, because, good heavens, the expectation was 25 basis points. Were you as shocked as I was? Good morning, Christie.
Good morning. Yes, everybody was quite surprised. There were one or two forecasts out there for 50, but really the majority of economists were looking at 25. And then the big question is why? And the big change from the Reserve Bank was that they increased their inflation forecast for this year quite substantially. As we know, this is all about inflation targeting. So based on that increased inflation forecast due to several different factors, they decided that they need to make a bigger than expected increase. This happens from time to time, where these inflation numbers are obviously revised often and where forecasts can be be caught in the wrong. So it's not the first time it's happened. It's just, I think at this point, people were really hoping for at 25 to be like the last move, and then unexpectedly it was bigger.
Yeah, it was bigger as well, and we were talking about last moves yesterday, so that expectation, you're right, was supposed to be. We were all hoping, all praying, all crossing our fingers it was going to be 25 basis points. Not to be. We got smacked with 50. But could we see another one? Because I understand there's an expectation that come May of this year, we could see another increase of about 25 basis points. Is that what your crystal ball is telling you?
Yes, I think very realistically at this point, and we have to obviously over the next 2 months see how the data comes out, but at this point probably another 25 in May. We know that the MPC, the Monetary Policy Committee that makes this decision, there's 5 members, all 5 of them voted for an increase this month. 3 of them said 50 basis points, 2 of them said 25. So we know that there is an appetite for them to still increase. So at this point, probably going to be an early forecast for another 25 in May. But as the Reserve Bank always says, these decisions are based on data. So in the next 2 months, we'll have to see how the inflation numbers come out, what the exchange rate does, the oil price, economic growth indicators, all of those before we can reassess late in May where inflation is actually going over the next 2 to 3 years.
And while we look at that as well, we have to look back to look forward, don't we, Christie, as well? We go back to Q4 of 2022, and there was a contraction there for the local economy as well. I remember a number 1.3% was the contraction for Q4 of last year, and I don't imagine the stage 6 blackouts and power cuts we had beginning of this year has done us any favors.
Definitely. One of the reasons why economists were expecting a slowdown in inflation, a slowdown in interest rate increases, is because of how weak the economy is. The economic growth last year of 2% was less than the Reserve Bank expected, and many people are looking at the first quarter of this year also maybe seeing a decline in GDP. That would put us in that technical recession situation. So it is of great concern that we have to keep lifting interest rates to fight inflation while the economy is struggling. And the Reserve Bank mentioned that. The governor talked about yesterday the issue about load shedding, which is both increasing inflation and reducing economic growth, something they can obviously not control directly. So it's a conundrum. It's a tricky balance they have to pull. But in the end, they have this mandate to fight inflation, which is the entity is aiming to protect the value of our currency, the value of our buying power. And if we don't reduce inflation over the next year or two, we could be sitting with a position where the rand keeps moving weaker and weaker, and then we keep importing more inflation. It's a bit of a vicious cycle. You can't let inflation just hang around too long. So that's why they are continuing with tightening the monetary policy situation.
And when we can bring this down to those watching at home and those of us who've got house bonds to pay and cars to pay off and fuel to put into vehicles, etc. as well, when we start getting hit with these increased interest rates, cost of living goes up, which means I imagine the credit economy, the applications for credit are going to go up, which of course means if you are living on credit, because you can't afford currently what you're paying for, you're going to be paying even more on the credit that you've applied for because of this interest rate. I feel like we're on a very bad hamster wheel. It's like Groundhog Day.
It is, and it's a challenge because ordinary South Africans are now looking to credit just to pay for their food, the basic needs. And we are seeing more increased demand for credit to do this. Now, what the Reserve Bank always says is that they cannot substantially change the direction of economic growth in the country. And they'll always give you a long list of things that need to be fixed from the public sector side that will see our economy grow, that will create more jobs, and will enable more people to earn a salary to pay for their basic needs. If those things are sorted out, then fewer people will be dependent on debt just to pay for food, for example. So the Reserve Bank often gets that criticism where people say, listen, you are reducing economic growth, please stop this. And they would say, listen, and I agree completely, listen, there's a long list of things that need to be fixed in this economy that the Reserve Bank cannot control that would have a much bigger impact on economic and employment growth.
Christie, I'm going to ask our team just to bring up that graphic I was referring to before you and I started talking. Here it is again. If you just joined us, talking to Christie Viljoen, PwC senior economist. I wanted to bring this up. I'll tell you why. Christie, I'm not sure if you can see this. I'm sure you can. But if you can't, just for our viewers at home, right now, January 2023, 10.75 on the prime lending rate. But I'm wondering, can you help me understand, if I look at July 2022, what happened there? We were in the green, 7%. In July of 2020. I know we're going back a couple of years, but what was that sweet spot? How did we end up in the value of financial retribution? What happened in July 2020 when we hit 7?
So what happened in the first half of 2020, and we will all remember COVID-19 hit globally and locally, that was when COVID-19 arrived. At that point, the Reserve Bank said, listen, we're going to cut interest rates significantly to try and offer any kind of boost we can to the economy. So interest rates were lowered by middle 2020 to the lowest in, I think, about 5 decades, to try and just support the economy during what was definitely at that point a recession. We were always told when that was happening, interest rates will go back up again. They will have to sort of normalize to where they were before. And that's what started late in 2021. The Reserve Bank started lifting lending rates again with the intention of sort of getting them back to the level they were before the pandemic. We know that at the moment we're already beyond that. We are already with higher interest rates compared to before COVID-19, and that is because inflation has become such a problem. One of the key reasons behind that is the Russia-Ukraine situation, which just globally disrupted all kinds of trade in markets, and commodity prices are up. So it was somewhat unexpected, I think, when the Reserve Bank started lifting interest rates, that we are now as high as we are. But that is the next part of the story, the inflation story that needs to be handled.
The story is starting to look a bit like a horror novel at this point. PwC senior economist Christie Viljoen making time for us this morning. Christie, always good to have you with us. So just